5 a.m. in New York City. Good morning, I'm Vonnie Quinn with your Bloomberg Brief. Here's what you need to know. A potential mass layoff. The White House Budget Office tells federal agencies to plan for job cuts during a possible government shutdown. A bid for a comeback. Intel extends gains as it's said to have approached Apple to secure investment. And stock futures fairly steady after 2 days of losses for the major indices. Jobless claims among the data on deck as Daly and Goolsbee diverge publicly now on rate cut views. So let's take a look at those futures because we are very fractionally lower. Now, we have had 2 days of declines, but for the S&P 500, those 2 days don't even add up to 1% of a decline. And September hasn't really turned out to be the gloomy month that it tends to be in a typical year. We're still up 2 3/4% month to date, even with those 2 days of declines, which, as I say, for the S&P don't even add up to 1%. So we'll see how we fare today. Let's take a look at yields because we have backed up from the lowest levels, but we are sticking around these levels now. The 2-year, sure, it's up a few basis points. The 10-year yield actually too, we're at 4.14 now, but that 30-year yield is still sticking to under the 4.75 mark. We're going to be speaking to Apollo's Torsten Slok in just a little bit. We'll ask him all about the yield curve and what it is signaling. I do want to point out too that the VIX is above 16, not exactly elevated, but in terms of volatility indexes, they're all really low right now. So is there complacency out there? Not too sure. We'll have to find out. Let's get to some individual stock movers now. Over to London and Valerie Teitel. Valerie.
Good morning, Avani. Let's start with a check on Intel after it was reported by Bloomberg that they have approached Apple in seeking an investment. The shares are reacting positively to this report, up to shy of 4%. Now, sources have told Bloomberg that these two companies have discussed working more closely together, and this comes in the context of the fact that Apple used to use Intel chips in its devices, but that was a phase out that began in 2020 and completed in 2023. Now, while investors in the market seem unlikely that Apple would use Intel chips again, it still is reacting positively to this news of a potential investment. Next, let's move over to the car rental industry. Hertz shares jumping this morning, up 8.3% after they announced a $250 million senior note offering in a private placement that would help its pay down its near-term debt. It is suffering from some sort of a debt crunch with notes due in 2025 and 2026. So Hertz reacting positively to that private placement. Lastly, let's head over to Sweden. H&M, the retailer, they're jumping after earnings, up over 9%, a massive beat on profit and margin as they struggle with their turnaround, but it's looking good. This is now their second beat in a row, quarter on quarter. They are now focusing more back on their H&M brand, and also cost cutting help them with their margins. Funny?
Valerie, that's amazing. Thank you so much. Valerie Teitel there in London. And our lineup for you this morning will be live from the IPEM Private Equity Conference in Paris with Tony Tutrone of Neuberger Berman. And later this hour, a deep dive into the labour market and inflation dynamics with Apollo's Torsten Slok. So back to our top story. Federal agencies are being told by the White House Budget Office to prepare for mass firings during a possible government shutdown. For more detail, let's bring in Bloomberg's White House correspondent, Tyler Kendall. Tyler, what is the normal government protocol during government shutdowns? Remind us, because it hasn't been that long since the last one, but still it's hard to remember.
Right, exactly. It feels like we are consistently at the brink of seeing the U.S. federal government shut down. And normally these workers that are deemed non-essential are furloughed and then they're brought back to keep working. Often they're given back pay in some sort of form. Instead, this really does mark a significant escalation beyond the normal shutdown protocol. This memo from the OMB Director Russ Vought directs agencies to identify programs and other spending items where discretionary funding is set to lapse October 1st, and there's no alternative for other funding. So in this memo, it then goes on to say, quote, such programs are no longer required to be carried out, essentially looking here to be a bidding by the administration to try to cut back on those programs that they deem might not be aligned with the broader policies. For example, the memo goes on to say that those priorities, those areas where the administration has really focused in on, such as immigration and border control, it looks like those funding areas would be kept safe.
And then, Tyler, we got word that the Department of Commerce has now started investigations into the imports of robotics, industrial machinery and medical devices. I say tariffs because I'm curious, how does it play into the Trump tariff playbook?
Right. Well, you're exactly right. This is considered to be the basis for future tariffs down the road. This is a Section 232 investigation initiated on the grounds of national security concerns. And it's interesting here because this is going to expand the scope of potential tariffs that we see. And it really does hit the broader based industries that impact domestic manufacturing more broadly. This idea of these tools, these robotics, industrial machinery that go into a broad range of sectors. Now, these investigations, they typically last 9 months, though this administration is known, of course, to be working on a little bit more of an expedited timeline. But what's really important here, Vonnie, is that 232 investigations, tariffs that are enacted through them, are considered to be more durable. These are the ones that have perhaps a stronger legal basis, as we've seen President Trump's more broad-based tariffs, those tariffs enacted under IEPA, the International Emergency Economic Powers Act. Those are the ones that are really going through the court system and seeing those legal challenges. So this signals to us that the administration is taking perhaps a broader view when it comes to tariffs and to make sure that they are more long-lasting to accomplish those goals of reshoring.
And of course, there are already 232 investigations outstanding into other industries and other parts of tech industries, for example. Are we awaiting any results anytime soon on any of them?
Right. There's a few, actually. This is, of course, not just limited to this. We know that investigations have already been started into pharmaceuticals, for example. That is one that we have been long awaiting. We have gotten some information from the White House on how that's going to be structured, likely a tariff that gets higher over time. You mentioned chips, critical minerals. We are still waiting for that right now. Of course, there's this exemption that impacts the entire supply chain, comes as a reprieve to those critical industries, but we're still going to have to wait and see. And then the last one I'll put on your radar, aircraft are currently going under a Section 232 investigation. And we've seen in recent weeks leading up to the United Nations General Assembly, President Trump making these deals around Boeing. We know that aircraft is something that this administration in particular, when it comes to addressing persistent trade imbalances, has really been focused on. So I would expect those coming down the line.
All right, Tyler, we'll chat to you again. Thank you so much. That is Bloomberg Washington correspondent Tyler Kendall. Well, turning to tech, shares of Intel extending gains following a Bloomberg scoop that Intel has approached Apple about securing an investment. For more, joining us now is Bloomberg Tech Europe anchor Tom McKenzie. Tom, give us the details. What do we know about this approach?
Yeah, I mean, what a turnaround for Intel and its prospects, particularly when it comes to the question of liquidity. That seems to be less of a challenge for Intel right now. They've had that investment, of course, from the US government, about that 10%, approximate 10% stake. They've had that investment from Nvidia, around $5 billion. They've had an investment from SoftBank, $2 billion. And now, again, according to Bloomberg reporting, they are courting Apple for potential investment. Really intriguing given the history of these two companies, because of course Apple used to rely on Intel chips but have started to phase them out in the last 5 years. Now they have their own in-house designs, and those chips are produced and manufactured by the foundry TSMC in Taiwan. So we'll see how far this progresses, and it does again remind us that Intel has made significant progress in addressing its liquidity challenges. Now, what it has to do is see if it can actually get some significant customers for that foundry part of the business. Lip-Bu Tan, the new CEO, says he's still committed to foundries, but he's going to be more cautious and he wants to see some of those big customer commitments before he pushes out on the build on that. It seems unlikely that Apple is going to start producing and buying Intel chips again, but it may be beneficial for Apple, number one, politically, to be seen to investing in Intel, given the US government stake, and number two, to maybe have a bit of competition in the foundry space between TSMC and Intel.
Yeah, it'll be fascinating to see what Apple's response will be. Now, elsewhere, HSBC talking about quantum computing, saying its trial is actually beating out its Wall Street rivals when it comes to bonds and bond trading. How competitive is this space? I didn't realize we were at this point yet where it could actually be used.
Yeah, it's gone. Quantum computing has gone from the theoretical to the research stage to implementing in small levels and small cases. But HSBC's findings seem to be pretty significant. In fact, one of the executives told our team that he sees this potentially as a Sputnik moment for quantum computing. They were able to use a quantum computing processor to radically improve the calculations around how a particular bond would trade at a particular price, a 34% improvement. And if you think, of course, when you're looking at margins and percentage changes, minimal, that can be hugely beneficial on the balance sheet of some of these investment banks, 34% is clearly going to be significant. Quantum computers, they're very expensive, they're very hard to scale. We're still at the very early stages of this. There's all sorts of factors that go on with quantum processors that include things called qubits that are very volatile around temperature changes and other effects in the environment. So there's all sorts of questions in terms of how you scale this technology, but it seems like HSBC have made a pretty significant breakthrough with this. All sorts of implications for trading, for fraud, for encryption. Should this innovation technology continue to go at pace, which it seems to be doing? The timeframes are very difficult to pin down, not clear in terms of when this becomes really, truly scalable at cost. But we know JP Morgan, Citi and others are investing along these lines as well.
Certainly a hot area. Some quantum stocks have been on an absolute tear in recent weeks. Tom, thank you so much. That is Bloomberg Tech Europe anchor Tom McKenzie. Now to other top stories trending on the terminal this morning. Disney is preparing for President Trump to retaliate against the company for putting late-night host Jimmy Kimmel back on the air. Sources say Disney leadership has consulted legal experts and is confident it will win any case over broadcast licenses. Kimmel's return drew 6.26 million viewers, the most ever in the show's regular time slot. South Korea's investment projects in the US will remain in limbo until visa issues are resolved. The South Korean Prime Minister spoke to Bloomberg in an exclusive interview.
Realistically, without a solution, it's difficult to invest in the United States and carry out the various joint projects currently planned between South Korea and the US. We absolutely must find a solution. Several projects are underway between South Korea and the US. Without resolving the visa issue, meaningful progress remains virtually impossible.
And Denmark is investigating potential Russian involvement after a second drone attack this week. Large professional drones were spotted at 5 regional airports in Denmark, disrupting flights. The country's defense minister said the incidents did not look like a coincidence. They looked systematic. Coming up, private credit seeing a pullback in fundraising. Our next guest, though, remains optimistic. Anthony Tutrone, Neuberger Berman Global Head of Alternatives, joins us live from the IPEM conference in Paris. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. The $1.7 trillion private credit market has seen fundraising slow in recent months. Defaults also beginning to creep up, prompting concern about underappreciated risks. Despite that, Anthony Tutrone, Global Head of Alternatives at Neuberger Berman, is predicting growth in private markets over the next 5 years will dwarf what we've seen over the previous 10 years. I'm pleased to say Tony joins us now from the IPEM Private Equity Conference in Paris. Tony, a broad question first. The Fed has kicked off its rate-cutting cycle. What does that mean for the private credit universe, given that much of it is floating rate?
Yes. So on one hand, it makes absolute returns lower. So you're going to be looking at slightly lower yields. But the best part of it is it's going to make it easier for companies to cover their interests. So those low rates will make companies more creditworthy and hopefully also spur some growth in the economy, which would also be helpful.
What stresses are you seeing in the system? We are seeing defaults creep up. Now they're still low, but we're not used to seeing defaults in private credit. We're talking about 2 to 3% and creeping higher.
Yeah, so I think some of those are some very aggressive deals that were done kind of in the 2021, 2022 period. And it was mostly on the large end of the market. We're quite fortunate at Neuberger Berman. We really focus on the middle market. We have not seen that in our portfolios at all. And we also avoid some of the industries that are probably having more problems facing tariffs than others. So I think the credit market on the private market side is going to be really about credit selection and about picking the right managers. But if you compare private credit to other areas of credit, I still think you're getting a premium return with similar or less risk. So compared to other areas, I do expect overall private credit will perform very well, even if we have a slowdown in the economy.
Tony, NB has been using some novel securitization structures in recent months, collateralized fund obligations, for example. What are the threats that come along with these?
So whenever you have new technologies that deploy leverage, there's always risk. So again, it really has to do with the underlying quality of the assets that are in these securitizations and making sure that your coverage is good, even in scenarios where you have distress, slow economic growth, or other factors. So I think the results are going to be mixed, depending on the underlying assets. So investors in these types of transactions, I think, are really going to have to be careful about their selection of where they play. On the other hand, these are innovative structures that allow insurance companies and others to buy the types of securities that help them meet their portfolio goals. So overall, these innovations are good, but whenever you have new innovations, you will see winners and you will see losers.
Sure, and Isabel Samama of AXA just told our Kriti Gupta earlier that, it could be the case that the fact that private markets and insurance companies are very closely linked now, that there might be systemic risk, maybe less so in Europe, but she pointed to the US as a place where there could be systemic risk. What are your thoughts on that?
Yeah, so whenever you have joint ventures, mergers, partnerships, some are going to be highly successful and some are not going to be successful. And it has to even do with things like culture, what are the goals and the parameters, and what are the risks that all the parties are taking. I don't see any huge systematic risk from my point of view, but I do see probably many of these partnerships may not achieve their goals, and I think there's already signs that some of them aren't. On the other hand, some of them will be highly successful because there is real synergies and real reasons why insurance makes a good partner with private markets and how they can help each other meet their goals.
Tony, what are your general partners telling you about valuations for the fourth quarter? Should we be looking at more markdowns?
Yeah, so I don't think so. I mean, right now, private equity is always on a delayed. We have the second quarter numbers in. They're good. Not as good as they've been in some of the runs that we had in 21 or 22. But on average, portfolios were marked up. Less than 20% of buyouts were marked down. And I think right now, the economy is still pretty strong across the developed markets. Unemployment is low. Again, we don't see a lot of issues in the portfolios, although we are seeing slower growth. We're a very growth-oriented shop, and over the last 5 years, in the direct equity and credit investments we've made, which is 600-700 companies, they've been having double-digit top-line growth. The most recent couple quarters, we're seeing high single-digit in the companies that we're investing in. So I definitely think there's signs of some slowness in the economy, and I think that's something that we're going to have to watch very closely. But overall, I'm expecting valuations to continue to rise as these companies grow and the private equity firms implement their operating and strategic strategies to accelerate earnings growth.
Tony, I'm sure you're always extraordinarily discerning about who you choose to finance and so on, but you did mention a few times now winners and losers and picking very particular parts of the market. So where are you all in, and where are you avoiding like the plague?
Yeah, so we think that the benign economic environment that private markets have had for many years that gave them a bit of a free lunch is over, and that the dispersion of returns among different firms is going to be much greater. And we've seen that in the last 5 quarters of data that we track. We track thousands of companies, hundreds of funds, and we're seeing that dispersion occur. And so within the buyout world, it really is about, we think, making money by making your companies better. And so the firms that have deep vertical expertise and lots of resources to go into those companies and provide them with coaching, with resources, with infrastructure, to accelerate earnings growth, they're going to be successful. It's a way to make money away from the market. We also have a bias towards the middle market. I mean, you saw in 2024, 6 firms raised 60% of the private market's capital. That was up from 20% 5 years earlier. So you got to follow the money flows in our business. I'm not saying that you can't get good risk-adjusted rate of return on the higher end. Those firms have lots of resources. They're investing in really great companies. But the middle market has a real opportunity because they're struggling to raise money. There's less money flowing there. It's going to be less competitive. And they are going to be able to build companies that I think the big guys are going to have to buy. Not only will want to buy them, they're going to have to buy them.
We'll get you back for an update on all of those companies very soon, Tony. Thank you. That's Tony Tutrone there of Neuberger Berman in Paris. This is Bloomberg. Time now for your front page news. First up on the New York Times, a gunman opened fire at a Dallas ICE office Wednesday, killing 1 detainee and injuring 2 others. The gunman died of a self-inflicted gunshot wound. The shooting was the second at a federal immigration facility in Texas in recent months. Next up, the Wall Street Journal reports that Delta Airlines is replacing power units on more than 300 Airbus jets to address cases of toxic fumes leaking into the air supply. A Delta spokesman said it's about 90% of its way through the process of upgrading the engines. And then the FT, stablecoin issuer Circle, looking at ways to make reversing transactions involving its tokens possible. Circle's president said a mechanism that allows money to be refunded would help the industry's mainstream push. Do stay tuned. This is Bloomberg. It's 5:30 a.m. in New York City. Good morning. I'm Vonnie Quinn with your Bloomberg Brief. Here's what you need to know. A potential mass layoff. The White House Budget Office tells federal agencies to plan for job cuts during a possible government shutdown. A bid for a comeback. Intel extends gains as it's said to have approached Apple to secure investment. And stock futures fairly steady after 2 days of losses. Jobless claims among data on deck as Daly and Goolsbee diverge on rate cut views. Let's take a look at those futures now, because we are lower for the most part, just very fractionally though for the S&P and the Nasdaq 100. 2 days of declines, but it doesn't even add up to 1 full percentage point. And I do want to point out that we're up 2 3/4% month to date so far for the S&P 500. So just a little pullback, maybe a little softer when it comes to risk sentiment. The VIX though is above 16, even if generally volatility indexes are trading near their lows across asset classes. Let's look at yields, because the 30-year is still below 475. In fact, down another basis point below 474 now. The 2-year and 10-year up very slightly, 360 and 413. We have the perfect guest to talk about all of this in just a moment. But before we get to Torsten Slok, let's get to some individual movers. Over to London and Valerie Teitel. Valerie.
Good morning. Let's start with a check on Intel. After Bloomberg reported they have approached Apple seeking an investment. Investors are reacting positively to this report. The share up 3.8%. Now, sources have told Bloomberg that these two companies have discussed working closer together in the future. And this comes under the context, Vonnie, that Intel's chips used to be used in Apple's products up until 2023. Now, while investors think a return to using Intel's chips is unlikely, we're still reacting positively to the possibility of a possible investment. Let's move over to the car rental space. Hertz shares doing very well so far in pre-market, up nearly 4%. This comes off the back of a $250 million senior note offering that they announced yesterday in a private placement that would help them with a near-term debt crunch. So those shares reacting positively to this news. Lastly, let's go over to Sweden. H&M out with results this morning. Absolutely flying when it comes to their share price, up 8.5%. A large beat when it came to margins and its profit, really signaling that this rebound, a turnaround is really looking good for the Swedish retailer. Vonnie?
Valerie, thank you so much. Valerie Teitel there. Torsten Slok of Apollo has been warning about the labour market for some time and now is concerned the inflation trend is no longer in the Fed's favour. He writes, quote, "The more general story is clear that there is upside pressure on inflation from tariffs, immigration restrictions and a lower dollar." Torsten joins us now. He's chief economist at Apollo. Torsten, Austin Goolsbee writing in today's FT that he could be less willing to support further cuts at future meetings because inflation is now headed in the wrong direction again. And you pointed out this week that 72% of components in the CPI are growing faster than the Fed's 2% inflation target. Should the Fed be done for the moment?
Well, the challenge for them at the moment, Vani, is that there are these impulses coming from tariffs is putting upward pressure on inflation. We also have upward pressure on inflation coming from the lower dollar. And we also have upward pressure on inflation coming from immigration restrictions and deportations, creating more wage inflation in the sectors where unauthorized immigrants are working. So these upside pressures are beginning to, unfortunately, become more sticky. And that's why the consensus expects inflation to be around 3% for the next 12 months. And that's significantly higher than the Fed's 2% target. So it makes sense that FOMC members such as Austin Goolsbee today are worrying about that maybe we have a problem that inflation is unfortunately not quite trending down to 2% the way that we would all like.
So is it less likely we'll get 2 more cuts this year, do you think?
Well, I think the challenge for the Fed is that on the one hand, high inflation says that the Fed should actually be hiking. On the other hand, the labor market is weakening, as you also mentioned earlier, and the weaker labor market that we had, especially here in the last several months, is pointing in a direction that the Fed should be cutting. So which one is it? Where will the Fed put weight? Will they put weight on inflation being high, which argues for not doing much, meaning keeping rates at these more elevated levels? Or will they begin to cut rates further simply because they're so worried about the labor market and the softening we've seen? It's clear that Jay Powell, including in the speech here yesterday, has been saying, well, they are worried about the weakness in the labor market becoming more persistent, but it's all about how long is the shock coming after Liberation Day? Is the trade war something that just will take a few months and then we're off to the races again? Or is this something that has elevated uncertainty to a new level where companies are under more significant headwinds for a more extended period?
So if we're not sure which way the Fed is going to lean at the next meeting, what is 475 on the long end and what are we, 360 now for the 2-year yield telling you that the Fed will do this year?
Yeah, so that's one. Exactly, the yield curve shape here is very important because on the one hand, the dot plot is telling us that the answer to your question is that the Fed will be cutting more. That is their expectation. So we in the market should expecting front-end rates to come down. In the long end, in particular, if front-end rates come down very quickly, there is a risk that inflation could remain not only sticky at 3, but potentially go up even more, especially if the dollar would begin to go down more significantly. And at the same time, we still have fiscal pressures putting upward pressure on the long end of the yield curve. So it still is the case that we should expect the yield curve to steepen, mainly because the Fed will be cutting, but also because we have significant upside pressure on the long end, partly because of inflation being sticky, but also because of the fiscal challenges still exerting more upward pressure on the belly and in the long end, and yields therefore staying at high levels when it comes to 5- and 10-year rates.
And of course, all the other questions in the background too, like a potential shutdown, which looks more likely now, and of course, Fed independence. How far away are we from significant job market weakness, Torsten? I know you talked about wage pressures feeding into inflation. We also had the Fed chair talking about how AI might be playing a role in what we're seeing, and migration might be playing more of a role than we had thought.
That's exactly right. And the issue of migration is very important because it is the case, absolutely, that border encounters are essentially zero. So that means that we've had a fairly sharp drop in immigration this year relative to last year. That does mean that there are simply fewer new entrants into the labor market. So simply because of lower immigration, we should also expect to see lower job growth. But the question is, and this was very importantly pointed out by several FOMC members, including by Neil Kashkari from the Minneapolis Fed, it is the case that it's not only lower immigration that has lowered employment growth. It is also a decline in demand for labor. So the fear that you can have is that the headwinds coming from tariffs, the headwinds coming from also student loan payments restarting earlier this year are all at risk of putting further downward pressure on the labor market. So that's why the conversation around what should the Fed do, there are really a lot of question marks and uncertainties around the labor market trajectory and also the inflation trajectory. But they are telling us with the dot plot that we should continue to expect more cuts to come.
Governor Myron is coming up on Bloomberg TV in just a couple of hours. I want to ask you about his Economic Club of New York speech. What in there made sense to you and what caused friction with your outlook?
Yeah, he has really put a very important foot down here in the discussion about what is the terminal rate. He did some work where he showed in a table in his speech and some calculations that he thought that the R star and therefore where the Fed funds rate is going to end up during this cycle is dramatically lower than what basically everyone else on the committee has been saying. So that's why there's suddenly a whole new debate emerging around, well, maybe the current forward curves pricing that the Fed funds rate will end up at around 3, that maybe there are some arguments coming from him that maybe the Fed funds rate should be significantly lower. So that's why the direction of travel is that interest rates are going modestly lower here. But it all comes, as you also mentioned, at a tailwind. At the same time, in AI, we have a tailwind, of course, significant spending on energy transition, on climate, on infrastructure. All those things have to be weighed against each other and still argue here for slightly lower rates. But in my view, still rates that are significantly higher than where we were for the long period from 2010 to 2022.
Torsten, is it possible that this slowdown could be temporary, that things improve next year once particularly trade war dynamics at least settle?
That's exactly right, Vonnie. So this becomes hugely a function of how do we think about what role does the trade war have on the economy? Is it the case that after Liberation Day, yes, it was a bit of turbulent for the economy, and therefore we have seen consumer spending slow down. We've seen business spending outside of AI has also been slowing down. And now we've also seen job growth slow down. Is this just a temporary shock to the economy because of what happened in April? Or is this something that is a more permanent state of uncertainty for companies, where companies are now more permanently stepping on the brakes with hiring, and consumers are permanently more stepping on the brakes with consumption? And you can begin to fear that some of the indicators, especially again on the labor market, they do become very important, and they are suggesting that maybe this is going to take a while longer. So yes, therefore, Vonnie, the core question in markets at the moment is the trade war just a temporary shock, or is it something that is going to have a longer lasting effect well into 2026?
Torsten, always wonderful to have you. Thank you so much. And do read Torsten's Daily Spark. That is Torsten Slok, Chief Economist at Apollo. Coming up, mass layoffs in the event of a shutdown. The White House Budget Office is preparing agencies for job cuts. That's next. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. Now, the White House Budget Office is priming federal agencies for mass firings in the event of a government shutdown as that deadline looms. For more, let's bring in Bloomberg's White House correspondent Tyler Kendall joining us in studio in New York. Tyler, remind us of the process. What exactly happens? I can't seem to remember the last time, even though it wasn't that long ago.
Right, exactly. It feels like we go through this process every few months or so, as this Congress has really preferred to do continuing resolutions, kicking the can down the road. Now, this marks a significant escalation in rhetoric and threat from the Trump administration, because normally we see those non-essential government workers furloughed but then brought back with back pay. Instead, we're seeing this memo from the OMB, which is directing agencies to come up with a list of workers whose activities are not paid for via mandatory funds or any new funding from the One Big Beautiful Bill, as well as to make a list of programs deemed inconsistent with the president's priorities. And these are the areas that could be on the chopping block. Now, OMB did not provide additional details. We don't know how big these layoffs could be, but it's important context to keep in mind that 6 out of 10 federal workers are typically deemed essential during shutdowns, which means that they keep working, while 4 out of 10 are told to basically stand by until Congress reopens the government. So, of course, this could have some very big economic implications here, Bonnie. But just for an update on how these negotiations are going, they're not going too well. We had been reporting that there was going to be this high-level meeting at the White House, actually today, between President Trump and Democratic leaders, including Hakeem Jeffries and Chuck Schumer. But then President Trump posted on Truth Social earlier this week saying that it's not worth his time to meet with them. And that has sort of derailed this process. I can say at the heart of this, the potential agreement could revolve around some changes when it comes to health care provisions. We know that Democrats want to see an extension or made permanent Obamacare tax subsidies that are set to expire. They also want to see some changes from the One Big Beautiful Bill, but it's really hard at this point to see that Republicans would make any changes to the president's signature legislation.
Amazing. So many people in Washington, D.C. wondering if they're going to be furloughed literally next week. Now, the other thing I wanted to ask you about is new Department of Commerce investigation. So this time it's the imports of robotics, industrial machinery and medical devices. When can we expect some kind of an answer?
Right. So this is a Section 232 investigation. It is enacted over national security concerns. Typically, Section 232 investigations take about 9 months to complete, though this administration has been known to work a little bit faster here. But essentially, this could be setting the stage for some more broad-based tariffs. It's interesting to see which industries are going to be impacted. These are the machineries, the robotics that go into the broader-based domestic manufacturing base. So it really does play into President Trump's efforts here to reshore. I'll quickly add that Section 232 investigations really are known to be the ones that have that more durable legal basis, as we've seen now repeatedly. Some of the Trump administration's other tariffs, those enacted under IEPA, for one instance, face those legal challenges in court.
Tyler, thank you so much. That is Washington correspondent Tyler Kendall. And let's get more details on this now with Brendan Murray, our trade czar. Brendan, what more can you tell us about these new Section 232 investigations and, of course, the ones that are ongoing?
Yeah, exactly. So these tariffs, these sectoral tariffs, and there are now 12 ongoing investigations of a similar sort, would be stacked on top of the reciprocal tariffs that President Trump rolled out in August, country by country. So I think what you're going to see over this period of the investigation is a lot of pushback from manufacturers who use robotics, particularly automakers. I believe that they are the number one user of foreign imports of robotic machinery, and hospitals and medical equipment purchasers are going to be hit by this. So, you know, the president likes to talk about lowering healthcare costs, but the hospital industry would say if you start putting tariffs on syringes and gauze and, you know, sort of medical supplies, you're only going to raise the cost for domestic use. So you're going to see a lot of pushback from these industries for robotics. Some of the biggest suppliers overseas are Japan, Germany, Korea, Denmark, and Canada. So those countries are all, you know, in various ways in talks with the administration to try to reduce their tariff burden.
Yeah, it's amazing. Usually when some of these are announced, we can sort of see the reasoning behind it, you know, but this one's a little bit more opaque. Now, we have formally now set tariffs on EU autos at 15%. Is that a relief in some senses to European car makers?
Yeah, this was expected, but it took almost 2 months from the time that the European Union and the U.S. signed this deal at President Trump's golf club in Scotland back in late July. So it was a bit of relief. European automakers are looking at these 15% tariffs now compared to the 27.5% tariffs that they were looking at before. But of course, steel and aluminum, those tariffs still are stuck at 50%, a very high rate. The European Union is the largest exporter of steel and aluminum to the U.S. So Brussels is really trying to get some sort of clarity on what's going to happen with those sectoral tariffs that are already in effect and are hurting European producers. They're hoping to get some sort of quota system where those tariffs would be zero up to a certain quantity of exports to the U.S. But that still has to be worked out, and those are industries that President Trump has made very clear that he's going to protect as best he can with that high tariff wall of 50%.
Brendan, thank you so much for all the context. That is trade czar there, Brendan Murray. Turning to tech now, shares of Intel rising in the pre-market. That's after a Bloomberg scoop that the firm is seeking investment from Apple. For more, joining us is Bloomberg Intelligence tech analyst Matt Bloxham. Matt, how unusual is it that Intel has approached Apple, and what could an investment bring to Intel?
I don't think it's that unusual, you know, given the context that Intel's going through a massive kind of overhaul and transformation under new leadership. They're obviously struggling a lot, losing momentum to NVIDIA in the chips, and have really struggled to kind of make this new business, the foundry business, essentially producing chips for other companies, really kind of take off. So I think this search for investment is really about that foundry business, and Apple could potentially be obviously a big customer of that business, and Intel's been reluctant to invest in the facilities it needs to expand this foundry idea without clear customer commitments, and those customer commitments have been slow to emerge, mainly because most people use TSMC, certainly for the kind of really leading edge chips, and Apple has a very close relationship with TSMC. Now, TSMC is building its own infrastructure in the US, under pressure from the US administration. Clearly, Apple feels that pressure too. So I think having a duality of supplier would also make sense for Apple. So we'll have to see where this goes. But I think that the talks do make sense in the context of what the US administration is trying to do in terms of bringing high-tech manufacturing back to the US.
Yeah, it's going to be fascinating to see Apple's response and what it comes up with for its part. Now, elsewhere, quantum computing. So HSBC is saying that its quantum computing trial is actually beating out its Wall Street rivals. How significant could this be for the lender, and how long will it take others to catch up?
Yeah, so I think for context, what HSBC did is they've used a whole bunch of real data about bonds and used quant computing technology to see if they could better predict where bonds pricing would sit, so they can essentially make a better margin and outcompete their rivals. And they found that something like a 34% improvement using quant computing versus current technology. So it's got potential. I guess my question right now would be whether 34% improvement is enough to make the commercial economics of quant computing work, because quant computing is still at an incredibly early stage development and incredibly expensive. But it is an interesting and exciting development. I think with everything that's going on with AI too, it's another example of how the financial industry is really at the leading edge of deploying technology to gain advantage. Obviously, historically, the hedge funds have been really involved in this, using their own fiber technology capabilities, developing their own data centers to get a kind of timing edge in the markets. And that would be interesting to see whether the hedge funds are looking closely at quant computing too. I think the reality is we're probably 5 to 10 years away from quant really becoming kind of widely available at kind of sensible price points, but clearly the investment's going there. And then when you combine the computing power of quant with AI, you really potentially into a kind of a whole almost unimaginable kind of world of technology developments, maybe in the next decade.
Yeah, the mind boggles. Can't wait to see it. Hope I'm around. Bloomberg Intelligence tech analyst Matt Bloxham, thank you. Coming up, a slew of Fedspeak in your day ahead. That's next. This is Bloomberg. This is Bloomberg Brief. I'm Bonnie Quinn in New York. Now a look at what's ahead today. First up, earnings before the bell from BlackBerry and CarMax. Then another round of jobless claims and GDP data at 8:30 Eastern. And a raft of Fedspeak from Goolsby, Williams, Schmidt, Bowman, Barr and more all throughout the day. Let's take a look at some individual movers pre-market now. Intel extending those gains on reports that the firm is seeking investment and closer working ties with Apple, up 3.5% plus. Opendoor up another 7.5% pre-market. We had a 13G filing from Jane Street, which shows a 5.9% passive stake, and that's just one of the catalysts that are moving this stock higher, let's just put it that way. Oracle down 2%, falling as Redburn initiates coverage of the firm with a sell rating, citing that the market is materially overestimating the value of Oracle's cloud revenues. So as we get you set up now for this Thursday of trading, let's take a look at where futures are pointing us. Well, they're pointing us lower after 2 days of declines. We knew there was a breather underway. Whether this will stick throughout the day, we'll have to see. What the next catalyst will be, perhaps after the data, we'll know a little bit more. Let's flip it to the bond side of things, because the yield curve just flattening ever so slightly. The 30-year staying at 4.74. We have the 2-year yield at 3.60. Not much movement in this early going. That does it for Bloomberg Brief. Surveillance continues the conversation. This is Bloomberg.